In 2007, I was managing billions of dollars at Oaktree Capital, and I was about to make what looked like the stupidest decision of my career. Credit spreads were at historic heights. Every investment bank was showing record profits. Private equity firms were raising unprecedented amounts of capital. And I was sitting on cash, mountains of it. Our investors were calling, asking why we weren't deploying. Other distressed debt funds were putting capital to work at 7%, 8% yields, and we were earning essentially nothing on our cash position. I had the analysis, I had the pressure. I had every rational reason to deploy that capital. But something made me pause. That pause, that decision to hold cash when everyone else was fully invested, that willingness to look foolish in the short term, saved our investors from catastrophic losses and positioned us to deploy $11 billion into the best opportunities of a generation when the crisis hit in 2008. What stopped me wasn't superior forecasting ability. I didn't predict the financial crisis. What stopped me was a principle I'd learned decades earlier about cycle positioning and the asymmetry of risk at different points in the market pendulum. That principle has protected more wealth for people over 60 than any brilliant investment insight I've ever had. Let me ask you something, and I want you to really think about this. Drop your age and what percentage of your portfolio is in stocks right now in the comments. I need to know who I'm talking to because what I'm about to share applies differently depending on where you are. And if you're serious about protecting what you've spent a lifetime building, subscribe to this channel now. This isn't about chasing returns or finding the next hot stock. It's about understanding where we stand in the market cycle and positioning accordingly. The kind of defensive thinking that's preserved wealth through 8 major market disruptions since I started in this business. Here's what I'm going to show you in the next several minutes. First, why the traditional advice about age-based asset allocation is dangerously incomplete. Second, how to read where we are in the market cycle right now. And third, the specific defensive positioning strategy that works regardless of what happens next. But you need to stay until the end, because the most important part, the actual implementation framework, comes in the final section. Let me start with what almost every financial advisor gets wrong about protecting wealth after 60. They tell you to subtract your age from 100, and that's the percentage you should have in stocks. So if you're 65, you should be 65% bonds, 35% stocks. If you're 70, 70% bonds, 30% stocks. It's simple, it's clean, it's taught in every financial planning course. And it's incomplete because it ignores the single most important variable in investment success. Where are we in the market cycle? Think about what that traditional formula would have told you to do in early 2000. If you were 65 years old, it would have said keep 35% in stocks. Then the market dropped 50% over the next 2.5 years. That 35% allocation cost you 17.5% of your total portfolio. At 65, when you're potentially drawing income from that portfolio, that's not a number you recover from easily. Or consider 2007. The same formula, the same allocation, then 2008 hits and stocks drop 57%. Again, that 35% allocation just cost you 20% of your total wealth. These aren't theoretical examples. These are real losses that real people in their 60s suffered while following conventional wisdom. Now, contrast that with someone who understood cycle positioning, someone who recognized in 1999 that we were late in a massive bull market, that valuations were at historic extremes, that the pendulum had swung to irrational exuberance. That person might have been at 10 or 15% stocks instead of 35%, even though they were 65 years old. When the crash came, they lost maybe 5 to 7% instead of 17%. More importantly, they had the capital and the emotional stability to buy assets when they were genuinely cheap in 2002 and 2003. This is what I mean by cycle-aware defensive positioning. It's not about your age alone. It's about the intersection of your age, your need for capital preservation, and where we are in the market cycle. And right now, after one of the longest bull markets in history, after a period where stock valuations by almost every measure are in the top decile historically, this matters more than it has in 15 years. The principle that saved me in 2007, the one I'm going to teach you today, isn't complicated, but it requires something that's harder than intelligence. It requires the discipline to look foolish in the short term, to hold cash when others are making money, to be defensive when the party is still going, to accept that you might miss the last 10 or 15% of a bull market in order to avoid the first 40 or 50% of a bear market. Over my 5 decades in investing, I've learned that the biggest mistakes aren't made by people who lack information. They're made by people who have all the information but lack the framework to interpret where they are in the cycle. They know valuations are high, but everyone else is still buying. They know credit spreads are tight, but deals are still getting done. They know the pendulum has swung far from center, but they can't bring themselves to act differently from the crowd. That's the mistake that destroyed the retiree I'm going to tell you about in a moment. Not ignorance, not bad luck, a failure to recognize cycle position and adjust accordingly. And here's what concerns me right now. I'm seeing the same patterns today that I saw in 2007. Not identical, history never repeats exactly, but the rhythm is familiar. High valuations, compressed risk premiums, widespread belief that this time is different. Investors reaching for yield in increasingly risky assets, and most concerning, complacency about downside risk. I'm not predicting a crash. I don't make predictions. Markets can stay overvalued longer than seems rational. The bull market could continue for another year or 2 years, but I am saying this. If you're over 60, the asymmetry of outcomes has shifted dramatically against you. The potential upside from staying fully invested is maybe another 20 or 30% over the next few years if everything goes right. The potential downside from a normal bear market is 40 to 50%. And if you're drawing income from that portfolio, if you don't have decades to recover, that asymmetry should terrify you. This is second-level thinking. First-level thinking says, the market has been going up, I should stay invested. Second-level thinking asks, what's the risk-adjusted return from here, given where we are in the cycle, given my specific situation, given my ability to recover from a major loss? Those are very different questions, and they lead to very different answers. Now, I promised you a strategy, not theory, but a specific framework you can implement. But first, I need you to understand the cycle positioning framework that makes this strategy work, because without understanding the why, you won't have the conviction to implement the how when it feels uncomfortable. The market cycle, as I've written about extensively in my memos, moves like a pendulum. It swings from undervalued to overvalued, from fearful to greedy, from skeptical to credulous. The swing is inevitable. What's not inevitable is where you're positioned when the swing reverses. And for someone over 60, position is everything. You don't have the luxury of riding out a full cycle. You need to be defensively positioned before the reversal happens. Let me show you how to read where we are. There are 5 key indicators I watch, and right now 4 of them are flashing caution signals. First, valuation. The Shiller P/E ratio, which smooths earnings over 10 years, is currently above 30. It's been higher than this only 3 times in history: 1929, 2000, and 2021. Each time was followed by a major bear market. Second, credit spreads. The difference between what risky borrowers pay and what safe borrowers pay is near historic lows. That means investors aren't demanding much compensation for risk. That's a late cycle signal. Third, investor sentiment. Surveys show bulls outnumber bears by the widest margin in years. When everyone is optimistic, there's no one left to buy. Fourth, market breadth. Fewer and fewer stocks are driving the market higher. That's a classic late cycle pattern. The fifth indicator, the one that's not yet flashing red, is the yield curve. But even there, we've seen inversions in the past year, and historically, recessions follow yield curve inversions by 12 to 18 months. I'm not saying a recession is imminent. I'm saying the weight of evidence suggests we're much closer to the end of this cycle than the beginning, and that should inform how you're positioned. Here's what most people do wrong. They wait for certainty. They want to see the crash starting before they get defensive, but by then, it's too late. The first 20% down happens fast. By the time you recognize it's a real bear market, not just a correction, you've already taken the damage. Defensive positioning isn't about timing the top. It's about recognizing when the risk-reward ratio has shifted unfavorably and adjusting before the obvious signals appear. At Oaktree, we started raising cash in 2005. Not because we predicted the 2008 crisis, we didn't, but because we recognized that credit markets were priced for perfection, that risk premiums were inadequate, that we were late in the cycle. We looked foolish for 2 years. Other funds were deploying capital and showing returns. Our investors questioned the strategy, but when the crisis hit, we had $11 billion ready to deploy into the best opportunities we'd seen in decades. That defensive positioning, that willingness to hold cash and wait, created generational returns for our investors. You're not managing billions, but the principle is identical. When the risk-reward ratio is unfavorable, when you're late in the cycle, when you can't afford a major loss, you get defensive. You hold more cash, you reduce equity exposure, you accept lower returns in the short term to protect against major losses that you can't recover from. Let me tell you about someone who didn't do this. In 2007, I knew a man, recently retired at 63, with about $800,000 in his portfolio. He was following the traditional age-based allocation, so he had roughly 35% in stocks, about $280,000. The rest was in bonds and cash. When the market crashed in 2008, that stock allocation got cut roughly in half. He lost about $140,000. But here's where it gets worse. He panicked, seeing his portfolio drop from $800,000 to $660,000. Watching the daily news about banks failing and the economy collapsing, he sold his remaining stocks in March 2009 near the bottom. He locked in his losses. Then, as the market recovered, he was too scared to get back in. He stayed in cash and bonds. By 2019, the market had more than tripled from the 2009 lows. If he'd just held his original position, he'd have recovered everything and been ahead. Instead, he was still down significantly from his pre-crisis peak. At 75 years old, he couldn't make up that difference. That's the tragedy I'm trying to help you avoid. Not the loss itself. Everyone who's invested has experienced market declines, but the permanent impairment that comes from being too aggressively positioned at the wrong point in the cycle, then making emotional decisions when the crash happens. If he'd been more defensively positioned in 2007, say 15% in stocks instead of 35%, he'd have lost maybe $60,000 instead of $140,000. That smaller loss would have been emotionally manageable. He wouldn't have panicked and sold at the bottom. He'd have maintained his discipline and recovered. This is what defensive positioning does. It's not about maximizing returns. It's about minimizing the probability of an unrecoverable loss. It's about keeping losses small enough that you maintain your emotional equilibrium and your capital base, small enough that you can participate in the recovery, small enough that you don't permanently impair your retirement. So what's the actual strategy? How do you implement cycle-aware defensive positioning? Let me give you the specific framework. This isn't complicated, but it requires discipline. Before I do, though, I need to know something. Comment below and tell me honestly, when was the last time you looked at your portfolio and asked yourself, am I positioned appropriately for where we are in the cycle? Not how much have I made this year, but what's my downside risk if we're wrong about where we are? If you can't remember the last time you asked that question, you need this framework. Here's the system. You're going to divide your portfolio into 3 buckets. Bucket 1 is your safety capital. This is money you absolutely cannot afford to lose. For most people over 60, this should be 3 to 5 years of living expenses. This money goes into treasury bills, short-term CDs, high-quality money market funds. You're earning maybe 4 to 5% right now, which after inflation might be close to zero real return. That's fine. This bucket isn't about returns, it's about certainty. If the market crashes tomorrow, this bucket is untouched. You can live off it for years while you wait for recovery. Bucket 2 is your income capital. This is money that needs to generate reliable income but can accept modest risk. This goes into high-quality bonds, dividend-paying blue-chip stocks, maybe some preferred shares. You're looking for 4 to 6% yields from assets that won't lose more than 20% even in a severe bear market. This bucket provides income and has some growth potential, but it's not where you take big risks. Bucket 3 is your growth capital. This is money you can afford to lose without impacting your lifestyle. For most people over 60, this should be the smallest bucket, maybe 10 to 20% of your total portfolio. This is where you take equity risk, where you invest in stocks, where you have the potential for significant gains but also significant losses. Now here's the key. The size of bucket 3 changes based on where we are in the cycle. When we're early cycle, when valuations are reasonable, when there's genuine fear in the markets, bucket 3 can be 20 or even 25%. But when we're late cycle, when valuations are extended, when everyone is optimistic, bucket 3 should shrink to 10 or even 5%. You're not trying to time the exact top. You're adjusting your risk exposure based on the risk-reward ratio. Right now, based on the indicators I described earlier, I'd be at the low end of bucket 3, maybe 10% in stocks. And even those would be in the highest quality companies with strong balance sheets and sustainable competitive advantages. The rest would be split between buckets 1 and 2. Maybe 40% in safety capital, 50% in income capital. That's a very defensive position. You're giving up potential upside if the bull market continues. But you're protecting yourself from catastrophic downside if it doesn't. Here's what you need to do this week. First, Calculate how much you're actually exposed to equity risk right now. Not just your stock allocation, but also any bond funds that hold high yield bonds, any balanced funds, any assets that will drop significantly in a bear market. Add it all up. If that number is more than 20% of your portfolio and you're over 60 and we're late cycle, you're taking more risk than you can afford. Second, decide on your bucket allocations based on where we are in the cycle. Be honest about where we are. High valuations, low risk premiums, widespread optimism, that's late cycle. Position accordingly. Third, implement the changes gradually. You don't have to do this all at once. Move 5% per month over several months. That way you're not trying to time a specific top. And here's what you need to track going forward. Watch those 5 indicators I mentioned. Valuation, credit spreads, investor sentiment, market breadth, yield curve. When they start shifting, when valuations come down, when fear returns, when risk premiums expand, that's when you can start moving capital back into bucket 3. But until then, stay defensive. Accept that you might miss some gains. Accept that you might look foolish if the market continues higher. That's the price of protection. And at your age, it's a price worth paying. I've spent 50 years learning this. I've watched 8 major market cycles. I've seen what happens to people who get the cycle position wrong. And I've learned that for someone over 60, being too aggressive at the wrong time is the one mistake you can't recover from. Not because you lack time, though that's part of it, but because the emotional damage from a major loss leads to worse decisions that compound the problem. That retiree I told you about, the one who sold at the bottom in 2009, he didn't fail because he lacked intelligence or information. He failed because he was positioned too aggressively for where we were in the cycle, took a loss he couldn't emotionally handle, and then made decisions based on fear rather than analysis. You can avoid that. You can position defensively now. You can accept lower returns in the short term. You can maintain the capital and emotional stability to make good decisions if and when the market turns. That's what cycle-aware defensive positioning gives you. Not maximum returns, but maximum probability of achieving your goals without permanent impairment. The choice is yours. You can follow the traditional age-based formula and hope we're not late cycle. Or you can look at the evidence, recognize where we likely are in the pendulum swing, and position accordingly. One approach is comfortable and conventional. The other requires courage and discipline. But only one protects you from the outcome that destroys retirements. I can't make the decision for you. I can only show you the framework and the evidence. The rest is up to you.